How can you earn your PhD in retirement? Well, this question may sound a bit odd, but we are going to explain what that means in our financial freedom video, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Welcome back to our channel. Well, Carson, understanding the retirement planning process can be so very confusing to most people because there's just so many rules and regulations to keep up with. But today, you're going to be providing insight on the basics that people need.
Yeah, Andrea, my goal today is to help you get your PhD in retirement. But before we talk about all of that, there are 2 rules to retirement income planning that we like to give you. And Andrea, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
So let's go ahead and jump into our lesson today, as we're going to do a 3-part series on how you can earn your PhD in retirement planning.
Now, Carson, with so many different products and different types of retirement accounts and rules, how can people close that knowledge gap and really feel like they have an understanding of the retirement landscape?
Well, Andrew, that's another good question. But here again, we want to keep things simple and talk about the most common tools that people should really get an understanding of. So let's go ahead and go back to our teaching slides so we can really explain this further. Okay, so now let's dive into the areas of the retirement planning process that you really need to understand. The first area that I want to cover is no other than Social Security, right? Social Security is a federal program that's designed to provide income to retirees based on their earnings history. In order to become eligible for Social Security, you have to have worked for an employer who's taken out for Social Security, and you would have to have accumulated at least 40 credits during that time frame. That's usually going to amount to about 10 years of work history for you to qualify for this benefit. Now, beyond that, you also need to know how that benefit is going to be calculated. It's going to be based on your highest 35 years of earnings, and it's going to be adjusted for inflation. Now, one of the things that you really should know is that if you have some zeros in that 35-year calculation, they're going to have that into your earnings history. And those zeros are no doubt going to lower the amount of your Social Security benefits. So if you're looking at your Social Security benefit history and you do identify some zeros, it could be important for you maybe to go back to work and eliminate those zeros in order to boost up your Social Security income. Another area under Social Security that you should really understand is the claiming age that you fall into. Now, everyone can start filing for their Social Security benefits as early as age 62, but if you do so, you'll have a permanent decrease of 30% on those benefits. Now, if you are informed or have the ability to wait, at your full retirement age, which is between the ages of 66 and 67 for most people, depending on when you were born, you will receive 100% of those benefits without any penalty. The next aspect of this benefit that you should also know that if you wait from your full retirement age to age 70, your benefits will increase by 8% per year all the way up until age 70. So if you were to implement that particular strategy, that will allow you to accumulate the maximum amount of monthly benefits from Social Security that you are entitled to. The second important area that I want to discuss when it comes to what you need to know about your retirement is understanding your employer benefit plan, like your 401ks, 403bs, 457bs. Understanding how to maximize the opportunities that you have with your employer benefit plans are vital when it comes to accumulating the right amount of resources to support you in retirement. So when it comes to a 401k plan, these are retirement saving accounts that are offered by your employer. Now, the first aspect of your 401k plan that I want you to understand and cover here are how the contributions work. Now, you can contribute a portion of your salary to your company's 401k plan, and many times these companies will offer matching contributions. So, for example, you may put in 5% of your salary, and your company will match that up to 5% as well. That is free money that you must take advantage of. And that's also a way where you can get 100% return on your dollars without any market participation. So you put in $1 and your company may match that dollar. So that's an important concept that you should understand when you start to work for any company. The next part of these contributions that I want you to understand are the tax advantages that you will have with them. Now, every year there is a maximum contribution limit that you can put into your 401k. So you should keep up with those matching contribution limits in case you want to continue to maximize your contributions within that 401k plan each and every year. But with that being said, you're putting those contributions in on a pre-tax basis, which inevitably can reduce your taxable income. So, for example, if you make $100,000 a year and you want to put $20,000 in pre-tax into your company's retirement plan, you're only going to be taxed on $80,000 of income for that year. So that's a major tax break that you want to make sure you take advantage of. Now, it's also important that you understand what's going to happen with those taxes when you start taking money out of those accounts. Those dollars are going to be fully taxable at your ordinary income tax bracket. Another thing about these withdrawals that you should understand is that you cannot start taking money out of those accounts before the age of 59 and a half. Because if you do, you could have a early withdrawal penalty of 10% if you're not taking those dollars out with some of the limited exceptions that you have. Also, you should know that if you're no longer working for that employer and you have money in that 401k, at your required minimum distribution date, which can be age 73 or age 75, depending on when you were born, you are going to be mandated to start taking distributions out of that particular account. Now, in part 3, we're going to finish up talking about IRAs, what you need to know about pensions, and what you need to know about Medicare. So make sure you tune in again next week.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.